So by doing that, it was a deliberate act of policy to remove demand or take demand away from physical gold and shunt it into something which people think is the equivalent.
Yeah, certainly a challenging time in the world for a lot of people, although things happening on the banking side. And I thought to start off with, it would be interesting to get your feelings on what's going on with Basel III and any changes that that has actually brought into the market now that it's, I guess, just about a year since that started going into effect. And perhaps you could bring people up to speed on what you're seeing there.
Yeah, I mean, it just hadn't really had all that much effect. I mean, one's got to understand that it's a background situation, and that is that it doesn't stop bullion banks or banks dealing in commodities or derivatives of commodities. It just makes it a bit more expensive for them to do so in terms of the overall allocation of their balance sheet. So I mean, let's face it, that dealing in whether it's gold, silver, oil, copper, whatever, derivative markets is an extremely profitable business. And even though notionally they may have staggeringly high short positions, in general terms, as long as they keep trading it, they will make money, and they make good money. And so I don't think we see any sign of it yet forcing traders, if you like, to be shut down by their banks. But there is no doubt that behind the scenes, the treasurers in banks will be looking at the management of their overall balance sheet, and they will be seeking, certainly not for their trading desks to increase their positions, but quite likely to decrease them over time. So I think that's the background of Basel III. We saw something come out of this. I think it was the Office of Currency Comptroller, I've probably got the wrong term, in America, which reallocated gold derivatives from foreign exchange category into commodities category or precious metals category. And so suddenly you saw this sort of huge, great spike of positions. A lot of people took it that this was, sort of rather sudden. But actually, if you read the note and the explanations behind it, it was quite clear that this was just a reallocation, if you like, within the Comptroller of Currency's books. And so that's the sort of thing, and that is in accordance, again, with Basel III. So we have an establishment which, in terms of Basel III, is looking at gold and silver as not money, having removed it from the foreign exchange side of derivatives, but actually is a commodity. That's the way they're looking at it. So this is pure Keynesianism driving it, because legally gold is money. I mean, it's as simple as that. Gold coin is money. Everything else is credit, as the original J.P. Morgan said. And he wasn't stating an opinion. He was stating a fact, a legal fact. And that is still true today, even though government administrations don't like you holding gold. They banned it in the past, as you know, in America in 1933. But, it's still legally gold. And it has been since Roman times. And it's been used as gold a long time before that as well. But it was formalized in Roman times, still true today. And that also goes for silver coin and copper coin.
Yeah, and in terms of that derivative position we've seen, can you put into perspective the composition of that, or what impact that's having on the markets? Obviously, we have the JP Morgan trial going on, and we see there have a large derivative position. Can you explain to folks what that actually means?
Well, yes, it's interesting because when that chart came out, it came out more or less, I think it was actually part of an article that Peter Hambro wrote. And Peter Hambro has been in the gold market, going way, way back. I mean, from the 1970s onwards. And he was saying, and it was absolutely clear, that the Bank of International Settlements, working with the exchange stabilization funds of the major nations, had a deliberate act of policy to turn the gold market from a physical market into something that they could manage. And that was the birth of unallocated gold positions, which were backed by nothing other than paper. I mean, credit, not the physical stuff. So by doing that, it was a deliberate act of policy to remove demand or take demand away from physical gold and shunt it into something which people think is the equivalent. And the thing that was interesting is that in that chart, you could see that there were two major players. You had JP Morgan and Citibank, or Citicorp, whatever they call themselves nowadays. And it is quite clear, if you take Peter Hambro's message about the Bank of International Settlements, exchange stabilization funds, etc., and combine it with the evidence from that chart, you can see that actually JP Morgan, in particular, and to a lesser extent Citibank, are purely agents of the US Treasury. They are leading the US Treasury's assault on the gold price. And it's as simple as that. So we now have a situation which, they've overstepped the mark, if I can put that very, very politely. And as a result, they were fined hugely for trades which they did several years ago. I think it was what, $930 billion or something, some incredible amount.
920.
I can't remember whether it was billion or million, but anyway. It was
920 million.
920 million, thank you. Okay, millions, not billions. Should be billions, but anyway. So they were fined for acting as the Treasury's agents. And now we find that their senior dealers, in the way they conducted themselves, they're now on criminal charges. So I think that is basically the situation. It's ironic that the Fed's agents have found themselves guilty of breaching the law, guilty of criminal charges. So, what more can one say?
Yeah, well, one of the questions that's come up with that trial, we've seen them talk about the spoofing, and it seems like went in both directions. And some people are wondering, okay, does that mean just it's manipulated, or is the price pushed down lower? We did have the comments from Peter Hambro, and there have been other data points that have popped up. But what could you say to folks who are wondering how to distinguish whether it's just that there's illegal behavior going on there, or if they have indeed left the price lower than it would be in a free market?
I mean, basically, it's very easy to get the price down, manipulate the price without resorting to criminal activities. I mean, the criminal activity is spoofing. Let's make that absolutely clear. But dealing in such a way to manage the price is actually not illegal. And it's very easy to do. I mean, if you have got the resources to do it, and banks generally have, because they can create the credit out of thin air in order to do it, then they can dump 10,000 contracts on COMEX, for example. Yeah. And that would have an immediate effect on the price. And they would do it in, quite publicly. They will know from their trading book where all the stops are, the bull stops. And so they know how to take them out. I mean, it's the easiest thing in the world to do. If you can print huge amounts of credit in order to create a short position, then it's money for old rope. It's as simple as that, and that goes on all the time. We haven't seen very recently the sort of 5,000 and 10,000 COMEX contracts being deliberately dropped at the wrong moment. That seems to have ceased for the moment, but it's happened in the past. I wouldn't rule it out again. But I think now with Basel III, there is this tendency to try and restrain the positions for most of these banks rather than increase them. Now, whether that's true of JP Morgan and Citi, who are obviously acting as the US Treasury's agents in this, I honestly don't know. I can't make that assessment, but I would have thought that it's sort of kind of difficult. And perhaps also, having gone through this bit of trying to control the gold price and, if you like, take attention away from it to try and persuade people that gold is a pet rock, whatever, I think all that has sort of diminished a little bit. And I think the priorities have changed somewhat. So perhaps we're not going to see that dumping of 10,000 contracts, et cetera, again. And of course, we're now in a very different environment because we have a very fragile global banking system. You look at the leverage in banks, it's very, very worrying, particularly in the Eurozone and particularly in Japan. I mean, you've got balance sheet leverage of over 20 times, and that's taking asset to equity ratios. And the equity funds in there, they're traded in the market at a very substantial discount to book value in almost all these banks. The exception, the honorable exception, actually, is the American banks. The major American banks trade usually at a premium to book value. But you look at some of the banks in Europe. I mean, the GSIBs, the global systemically important banks, the ones which will transmit systemic risk across the world. I mean, they're trading at something like 20 to 30% of book value. Now, that's option money on the survivability of a bank. It's giving us a clear message that these guys are in trouble. So I think generally it's an environment which banks will not want to increase their overall risks. They, I think, are contracting their balance sheets on if they can. And that's the way it's going, rather than expanding it into yet more derivative activities.